segment of life insurance. So today we'll be looking at segment 7, and we're going to start with taxation, the much promised segment that we've been waiting for. Now, with life insurance, there's a lot of things that we need to talk about when it comes to taxation. So if you remember before, we talked about how whole life policies have a reserve, which is called a cash surrender value. So if you decide to cancel your policy after a certain number of years, that is what the money that you're entitled to, right? So you can access that money. So your policy is not worth nothing at the end. You have something to sort of show for it, even at the end of your policy. All right. So when we looked at this, so we talked about the cash surrender value. So I'm going to go over an example with you in terms of how does tax apply. So if you're planning to cancel your policy after a certain number of years, how can you get access to your cash surrender value and how much tax will you pay on that? All right, so we have an example set here. Now, one important date to remember is December 1st, 1982. Now, this is an important date because at this time, some rules changed in the insurance company and they introduced a new sort of concept that we have to take into place. So if the policy was last acquired, and when we say last acquired, what do we mean by that? So if it was purchased before this date, or if they changed the face amount, if they changed ownership. So even if they purchased it before this date, but they changed, let's say, ownership after this date, that last acquired date will change. And that way, the new tax rules will apply. So what is different? So only thing that's different here is after 1982, there was another concept which was introduced called NCPI, and that stands for net cost of pure insurance. Okay, and that will be represented by a dollar figure, which will be given to you in the question. So let's take a look at some examples. So I have this board set up in 4 different parts. So we have post 1982 on this side, and we have post 1982 on this side and prior to 1982 on this side. So the first here is looking at non-participating policies. So remember, with whole life, you can have either participating policy or non-participating policy. And the only difference is participating policies offer dividends. So they give you a share of the profit. So let's start with our non-participating policy. And again, grab a calculator, do the calculations with me, just so it will make more sense if you do it yourself. So prior to 1982, what we're looking for when you need to figure out the taxation, you have to find the ACB, which is your accumulated cost base. Generally, ACB is described as your own cost, right? So if I said that you bought these valuable paintings, let's say for $50,000, and now they are selling for $200,000, so your ACB is the amount you paid, which would be $50,000, and then the gain is there, so it appreciated in value. Okay, so the ACB prior to 1982, and for non-participating policies, how do you calculate the ACB? It's just the premiums you've paid. So whatever premiums you have paid, that's your ACB, very simple. So we have the numbers here for our example. So we're going to say the premiums that we have paid is $20,000. The cash surrender value of our policy is $50,000. The MTR, which is our marginal tax rate, is 35%. And after 1982, we're going to need the NCPI, which is also going to be $5,000. So this is the numbers we're going to use, okay? So if we're trying to figure out our ACB for this example here, it's just a premiums paid. And I've already told you the premiums we've paid is $20,000. That means our ACB in this example is going to be just simply $20,000. Now, what do we do with the ACB? So we're trying to figure out how much tax do we have to pay in order to get the money from the cash surrender value. Now you paid the difference, you pay the tax on the difference. So you have your cash surrender value and you have to subtract the ACB, and whatever amount you're left with, that's what you have to pay tax on your MTR. Okay, so I'm going to repeat that one more time. So you have to take the cash surrender value, which will be given to you in the question. You have to subtract the ACB, and the amount that's left over, that's the amount that's taxable on the MTR percentage, okay? Now, what's important is that ACB changes in all of these different scenarios. So the definition of ACB is changing. That's why we need to figure that out. Okay, so this is the simplest one. ACB is equal to your premiums paid. So we have to take our cash surrender value, which is $50,000, minus our ACB, which is $20,000. So we have $30,000, which is taxable in if we're trying to access the CSV. And we have to pay tax on that at 35%. So you just take 30,000 multiplied by 0.35. And this is the amount of tax you're going to pay. So 10,500. Okay. And then the rest of that you take tax free. Now, let's say after 1982, you have a non-participating policy after 1982. So now the ACB is changing a little bit. It's not just premiums paid, it's premiums minus the NCPI, right? So the net cost of pure insurance. And what that is just the insurance company saying that we took a risk to insure you for all these years. That has to have a dollar value, right? So that dollar value will be given in the question. So here, after 1982, we have to take the premiums paid minus the NCPI, net cost of pure insurance, and then we're left with $15,000 because I've told you NCPI is 5,000. So we're going to take 20,000 minus the 5,000 and we're left with 15,000. So then we do the same thing again. We take our cash surrender value minus ACB. So this calculation, if you notice, is the same in all examples. Only thing that's changing is this number, ACB. Okay, so that's why our final answer changes. So when we take our cash surrender value, 50,000, minus our ACB, now it's 15,000 because the NCPI is also there. And we're left with 35,000. Then we have to multiply that. That's the amount that's going to be taxed at the MTR. Multiply by 0.35 for 35%. Now we're paying tax on 12,000. Now the tax that we owe is 12,250. So if you notice, after 1982, our tax has gone up because a new concept has been introduced. Okay, so that's a non-participating. Now, if we switch over to the participating policy, and I'm going to zoom in a little bit just so you guys can see, because my pen kind of started to fade there. So you can see the numbers a little bit more clearly. So now we have our participating policies. And for the participating, so we're taking the same numbers. So our only the difference is, remember, with participating policies, you have dividends. So we're going to assume that this policy paid out dividends of $5,000. So we have to use that number as well. Now, with participating policies prior to December 1st, 1982, how do we calculate the ACB? We have to take the premiums minus the dividends. Okay, so the insurance company is saying, we've already given this money back to you. We have to take that out. So premiums minus the dividends, and we're left with $15,000. So now we do the same thing. We take our cash surrender value, which is $50,000, minus ACB, which is $15,000, and we're left with $35,000. Then we have to take our MTR. So we take 35 times 35%. So we're paying $12,250 in taxes for this policy. Okay, so the difference is we just have to subtract the dividends with the participating policy that we didn't have to worry about over here. And now, what if you have a participating policy and it was last acquired after 1982? So now you have to take away the dividends and you have to take away the NCPI. So your ACB is going to get smaller. That means you will have to pay more tax. Okay, so let's take a look. So to figure out the ACB, we take the premiums that we have paid, which is $20,000. We're going to subtract the dividends that were given, which is $5,000, and subtract the NCPI, which is $5,000. So we're going to take 20, take away 5, take away 5. We're left with $10,000. So our ACB in this example becomes $10,000. Then we have to take our cash surrender value, which is $50,000, minus our ACB, which is $10,000, and we're left with $40,000. So we have to pay tax on $40,000 multiplied by 35%. So here we have to pay $14,000 of taxes. All right. So Go through it again if you need to. This calculation, if you notice, remains the same in all of our examples. Only thing that we have to do, because why do we have to do these calculations? Because we have to figure out what is the ACB. That's what's changing, and that's why our final answer is also changing. All right, so this is how we calculate tax with whole life policies. When we're trying to access that cash surrender value, that's how you calculate tax. All right, so join it. We're going to have the next part of our taxation where we're going to be looking at UL and policy gain as well. So join again for the next session.